All right, well, we made it to 9 weeks in a row this week. Are we going to get to 10 next week? What kind of market is this? How noisy is it? Are we in a trend right now? Are we going to get that pullback, if ever, that we've been anticipating? What are some of these other technical signs suggesting? How bullish is this bullish move that we've had? Have we seen this before? Those are all things I'm going to break down, as well as a trade idea on a stock that is on an established, strong bullish trend. That is regaining, on a long-term strong bullish trend, that is regaining some of its more intermediate trend now. And we'll take a look at how to trade that, so let's go ahead and get started. Today is Friday, February the 22nd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. Alright, well, let's start off looking at the S&P 500 with the market forecast indicator. You see that the intermediate posture remains strongly bullish here. Rising long-term market sentiment now getting easily above 50%, the orange dotted line here. So you've got good strong trends, emerging trends in the long-term basis. You'll see here in a second that we're still not quite established, but I'll show you the long-term in just a second here. Excuse me. The short-term sentiment, well, this is the Russell. Here's the short-term sentiment, and here, let me move up the moving average, or there we go, the Fibonacci retracement lines. You can see these continue to move up. Now the 50% line is sitting at the 38% retracement level. This is about the time that the Fibonacci fan is crossing through that area, the 62% Fibonacci fan of the decline. So interestingly enough, after having gone through it, we never did retest it. We kind of expected to retest it by, with this pullback kind of by now. And this probably would have been a lot more healthy for the markets if we'd be down here and able to bounce up rather than up here already, and then now trying to move higher on any potential trade resolution. It's very eerily similar to what we saw here in what we saw last year, right? When you had the trade, you had a nice good rally. You should have probably got this intermediate pullback right here. A lot of indicators I've mentioned before, a lot, and in our technical analysis class that we talked about today. We also looked at other things that would have suggested that we probably should have got an intermediate pullback right here. But we didn't, because we got a lot of tax reform. The tax reform bill was coming through and was going to get passed and voted on, and there were some ups and downs that got voted on, agreed to, and then the new year hit, and a lot of this new, a lot of the new tax reform, tax items were hitting, and it was looking really, really good for businesses. We never see, if we would have had a low point here by the time that was actually coming online, then we would have felt, you would have had a nice good rally, a nice good healthy, we could have continued this trend up without this really big case of volatility in between. But because we didn't have that pullback, because we continued to push and continued to push and continued, and really blew off on this really good news, the market couldn't take it anymore, and you ran out of buyers, and you had that drop, and all it did was get back, in that case, down to the 200-day moving average. But you can see again, and you can see we were bullish heading out of it. So, this wasn't really earth-shattering. You started to get some weakness in emerging markets in this area, and the markets continued higher while they didn't. But it was like we just kept going up. And we're kind of getting that right now too, here, where we probably should have pulled back in this area, right about in here. You probably should have followed that fan down towards Fibonacci support, and then bounced up on what is now turning out to be some positive news headlines coming between these the trade deals that are being discussed between U.S. and China. But we're kind of blowing up through, and we're getting up to really close to 2,800, getting above 26,000 on the Dow. That was the equivalent big round number. Just keep in mind, something to keep in mind here. So here is the mid-October high, here is the early November high, and here is the early December high. So you see how the S&P is just barely getting up to what was the early December high, and still below these other two. Well, look at emerging markets. So here's that mid-November high right there. There's a mid-November high. There's your early December high right here, and then there was the mid-October high right there. So they all got progressively higher, while the U.S. remember the early December high was actually the lowest of the three, and we are actually well above right now all three on the emerging markets, whereas with the S&P we are just barely getting to the December highs. If you look at the developed markets internationally, again, here is that mid-October high point right there. There's your mid-October high. There's your mid-November high, and then early November high, and then there's your early December high. Remember, we're just barely getting to that high on the S&P. We've already crossed through it with an overbought cluster. We've already crossed through it on the developed markets and are approaching the the other highs. So you can kind of see how more bullish we are in these international areas than we are right now in the S&P 500. Get back to the S&P here. But the posture remains bullish. The short-term sentiment is bull. In fact, the near-term line spiked up. Now, usually when the near-term line spikes up and you're already this bullish for this long, you start to get overbought clusters. So that's something to keep an eye on. In terms of like a sign of weakness. We didn't get it this time because we've had these couple of days of relatively long lower shadows here, considering how bullish we are. And in the last 5 days, we had a couple down days. That's brought the near-term line down, but not bearish enough, obviously, to bring it down below 50, but bearish enough to bring it down and keep any bounce from getting into the reversal zone today. So we didn't get an overbought cluster today, though. That momentum line, I mean, again, you go out, let's go out a little bit longer for some perspective on this momentum line. You can see all the times. Here, let's zoom out, and then we'll kind of drag this along. And when you're this bullish, you get some rallies, and this was in January 18. You start to see you got some really short-term rallies here without the overbought clusters when we were in the midst of this kind of like crazy run. And then you can see the other times you got the overbought clusters, and it led to some volatility, some ups and downs there. You come out to other periods where you were really bullish for quite a long time, and that spike in the momentum line actually ended up being the last spike before you got some volatility there in April of 17. This one we were kind of just starting, and it didn't quite get the same spike. It did get up above 90, and we weren't able to really get going any farther beyond that in 2016 before the pre-election volatility we had. So a little interesting sign that we're getting such a big spike on the momentum line when we're already have been so strongly bullish for so long. So not quite an overbought cluster because the near-term line wasn't up there, but we've seen this sign before where usually that kind of runs out, right? It kind of runs out of gas now. Another kind of exhaustion type, blow-off type move. As small as today's range was, that's what the momentum line alone at least would suggest. Alright, before we look at the long-term charts and some other charts as well, a reminder, subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your screen, the Market Scholars logo. Then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me two things. Number one, you got something out of the video today, right? Nice, easy way to give us feedback. It also says, number two, that you want us to keep doing the videos day in and day out, right? The worst thing, from YouTube's perspective, the worst thing you can do in terms of you just don't like this video at all is actually not to click or comment on anything down there. The more that you do click, it shows YouTube that this is a good piece of content that they should be suggesting to people who watch this type of stuff. So we really appreciate that. With that said, comment down below on anything that stood out to you today. What did you get out of it? As people come across this video, they'll see these comments and see why they should watch the video. Also, join our Daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click that link up there to subscribe. Very easy way to do that. Follow me on Twitter for more content like this in between videos from day to day. And also join our Market Outlook community that we created on Facebook. If you're watching our Market Outlook video on our blog, right above the blog there's a link to our forums, the Market Outlook forums on our website. You have to subscribe to our site. You can do that for free by clicking on this image. Very, very easy form to fill out there. But then you can participate with other people who watch these videos and comment and share other things that you're seeing with each other there as well. Ask each other questions. There's been people watching my Market Outlook videos in whatever version that I've had them out here on YouTube or at InvestTools for years, literally for years. So there's, if you have some questions, I'm sure people have had them before and we're more than willing to answer them for you. Also, while you're down here below the video, click this heart right below this on today's Market Outlook tweet. That opens up this new window. Click on like, and then also click on this image. Takes you to your Facebook page, and you can like today's Market Outlook post there by clicking on this icon. Again, those two things, same thing. When we see those clicks, that tells us, that's our way of knowing you want us to keep doing these videos. With one click, very easy. You can do all that right now while we're watching. Alright, back to the charts, and you can see the S&P had a one little bitty tiny down week. But for everybody else, that's 9 weeks in a row of upside gains. You can see for the Dow Jones Industrial Average, 9 weeks in a row to the upside. The Nasdaq Composite, 9 weeks in a row to the upside, and the Russell 2000, 9 weeks in a row to the upside. Very, very strong moves. The S&P now close to giving us the golden cross. It will next week, barring a big move to the downside below 2,700 like in 1 week. So you'll probably get that death cross, or golden cross, excuse me, next week. And remember, usually you end up getting a retest after you get these death cross and golden crosses. We didn't quite get that retest here yet at the 200-day moving average of the death cross, which is a good sign that the trend, and that we are changing the trend, that we're not going to be heading into a bear market, that this was not a bear market. It was just a deep pullback, deeper than what a lot of people are comfortable with because of how big the rally was that preceded, right? This rally that you had coming into it. I mean, aside from that Christmas, the FOMC kind of debacle, which was very, very temporary. I mean, that's the only thing that brought you below the 38% Fibonacci retracement of that rally, multi-year rally that we had coming off our last pullback, right? Our last death cross. So that was just a pullback, nothing more, simply because it was such a strong rally. It was not a bear market, and that's what this golden cross here is suggesting, and the lack of a retest at the 200-day moving average. But again, a retest back to the 200-day moving average and a bounce will solidify, like we saw here, the golden cross, right? When you get the golden cross, you get the retest. We got a couple of retests before we took off and stayed above it for a while. So nice multi-week rally. You can see what the Heikin-Ashi candles look like here. They continue to look really bullish, and next week's Heikin-Ashi open will be in the midpoint, or Heikin-Ashi open for next week's candle will be at the midpoint of this week's candle, which, if you see, it's the midpoint between the open and the close, and it's 274.19, 274.20 essentially is where that's at. So so that, again, you start to get a transition week when you get a lower shadow, and we still haven't got, all this time we haven't got a lower shadow, so no concern yet, at least on an intra-week basis, for a transition week to occur, which would be a transition more to that long-awaited retest, not necessarily of all the way down here to these lows, but off of these long-term averages that we just haven't gotten during this 9-week period. Now here's the other trend strength indicators again, and again, when you're looking at this trend quality and trend noise balance indicator, the trend begins in this case to the upside when the trend quality gets above -1, or gets above 1, and so obviously the bearish trend is when it gets below 1, is when the trend begins, and so not only gets above 1, but the trend noise balance says that needs to get above 50 for this to qualify as the beginnings of the trend. Other than that, it's a still very noisy chart. That's what this is saying. You had a big move to the downside. You've had a big bounce to the upside. The reality is, during this whole time, really since what, 2000, or from right here, this week of January the 15th, we opened right around 279.35, closing a little bit higher. We're basically just flat from that week to now, despite all that choppiness. And that's why you're not getting an established trend yet, something like this. And that's why even this 9-week rally would suggest that we don't have an established trend yet, because we don't, this is really a lot of noise, a lot of volatility. A big bounce up because the drop was so big, especially that last week. Kind of a little bit of a boomerang type of effect. Now, if you take a look at the 3 green, it doesn't mean that we can't make bullish trades, right? It just means that, those trend trades that can last for a long time, we might not have the nice, good opportunity, at least from this point, to enter a lot of those. At least with normal position sizes. You can enter anything with small position sizes, but with that normal, where we expect multiple months, we just haven't had that beginning of the trend yet. As of now, like this indicator suggests below, still pretty noisy. When you look at the 3 green arrows, you'll see that obviously we have 3 green arrows easily still. The MACD is really low. If I were to kind of zoom out on this, go out a few years, you can see the MACD had gotten pretty darn high, and when it gets really high on a relative basis, it will get low and stay low and pretty negative for a while after it gets to these high levels. Here it got to a high level and went negative, but we were in a bearish trend at that point. Here we are in more of a bullish trend. You can see some other examples where we got really bullish, and then it went in 2016 went really low. The MACD went negative for a long time as we just went sideways ahead of the elections. So, we're really bullish, especially with the stochastics, as bullish as it is, and forming lower highs across all of these as we progressively move up to higher highs. That's that divergence that we've talked about before. And you can see here, still got lower MACD highs, still got lower stochastic highs, despite the much higher highs we are. And again, the amount of days that we continue to trade above the 8-day moving average is just insane. So here's the MACD now, just comparing the price to the 8-day moving average, and you see we haven't been below the 8-day moving average since January the 3rd. So we're going on almost 2 months of being above, and you can see even in bullish trends you'll get below the 8-day moving average. And here's the beginnings of this bullish trend, and we got below the 8-day moving average. To go this long without dropping below is extremely bullish, right? We're really, in fact, again, you look at, if I were to change that MACD now to where we are relative to the 30-day simple moving average, so change that to simple, and I've shown you before how bullish that was, how bullish we had gotten up to this point, and how rare it is to get that high. Especially on a relative basis, we were very bullish there. We're diverging sharply from that, and we're starting to grind our way, as with the MACD histogram as small as it is, starting to grind our way back down, unable to really push away because of how high the moving average is, and that's what the histogram tells you. If you look at that moving average line, if I were to edit this here, let's find out the highest that moving average line got was around, what, 37 there, in the 37 area. Well, excuse me, the orange line. Yeah, 120. It looks like it got about to 121. It was as high as it got. So if I were to edit this and put it up to 121, so right on the top of that, and then zoom out a little bit just to see how high the MACD average got, you can see it's very rare for, the last time it got this high was when we were in the frothiest of frothy markets that we've had in a long time, at the early part of 2018, and we saw what happened. So a little concerning that we're actually this frothy again on the markets, at least from a technical indicator, appearing to be pretty frothy here. All right, now let's take a look at the intraday chart. And you can see we did get a higher high and a higher low today, and there's a very small trading range. The volume was also relatively, it ended up being about average, especially at the very end of the day when we had kind of some trade news hitting, trade tweets, hitting the the tweets, the headlines, the timelines. So we had some downs and back up and closing at the high, close to the high of the day, about 22 hundredths of a point, a quarter of a point away from the high of the day. You can see the brown lines are last week's trading range. This week's trading range will be very, very tight. And as I mentioned before, it was what, 274.19. That's going to be this purple line. So 274.19. So you can see now how we're starting to see, and that's up here. The last week's low point's also going to be right probably. Let's see, where was, the low? We opened up the week at 276.49. The low right here, 276.37. 35, so 276.35. There's going to be the brown line, which is going to be this week's low. Is going to move up to the green dotted line, so it's going to be way up there. There's the orange line, so you see how much easier it's going to be to get a lower shadow on the Heikin Ashi candle next week. And then this dotted line is way down here, but after 3 days next week and 4 days, and then 5 days, the low is going to move all the way. So barring any move to the upside that will push this high up higher, if the only thing that changes next week is this low moves up, then we're looking at the low point being right here about 267.25. That's what, 5.5 points. So you're looking at, what, 2 3/4 points change on this one. So you're going up to 273.5 ish. In this area is where the dotted line is going to move. If that low moves up by the end of the week and we don't get any new 4-week highs next week. So you can kind of see how now we're going to be really tightening up on the range, and it's going to be really easy for any pullback to get into the lower half of the range and to produce a lower shadow on, again, given the fact that we don't get a new 4-week high. If we continue to bust through the new 4-week highs next week, then this moving up will also kind of coincide with the low moving up too. So that would be great. It would keep a nice little distance here. We'd move away from the Heikin Ashi Open, no lower shadow. We move away from this week's low point, but to get below this week's low point, to get below the Heikin Ashi Open, will not be that big of a deal. We were below both those levels just last Thursday as it is. So, and we weren't that far away. So that just kind of shows you that as markets get more mature on the bullish side, the intermediate trend, you start to see the signs. You start to see from a short-term technical basis how easy it is to start the intermediate pullback, to get the reversals as you kind of monitor this chart day by day. You look at today's range and the volume on SPY. You can see the range was under 2 points, so well below average. The volume was at 77 million, so you put that in context of their averages. 2 points is way down here, so below the average. 77 million also below the average. Both those numbers very low within the 52-week ranges. The ATR itself is close to being below 1%, right? 2.79 will be the number, and we're very, very close. That's when the bullish trend has been established, right? So again, until then, noise, just like we saw before. And then finally, if you take a look at the volatility index, which has dropped below 14, this is crazy how bearish volatility has gotten. We've fallen below 90%. So here's what it looks like on a daily chart. So the last few days we've closed below. Here's what it looks like on the weekly chart. When you look at volatility on that 9-week basis, just dropping down from above 30 or just below 30 on a closing basis all the way down to 13.5. It's not too common for us to drop that far that fast. And you can see the 1 week we close below. Is that, you can see here in the midst of this volatility earlier this year, we also closed a week below. And then right after, over in this time frame, this would be May 7th. That's the week that the bullish trend got established. Which one is this one? Is this the week that the bullish trend gets established, or is this the just a close below that bounces right back up above it 2 weeks later and starts, with some higher volatility again, where we went from 15 all the way back up to 25? Probably, the odds would suggest would be the latter, that the bullish trend is establishing. But let's see what happens next week and make sure that this breakdown in volatility holds or not. All right, so now I want to hear from you. Do you agree or disagree with that market outlook? So there's a poll popping out in the top right corner of your screen. Click on that link that's popping out, then hit either agree or disagree in the poll. If you click on disagree, scroll down to the comment section down below. Share with us what you're seeing. Maybe you see something that I haven't shared. Maybe you see or have read something that would suggest either that we should be more bearish than what the market's suggesting, or that any expectations of intermediate pullbacks, we might be way off in terms of that. Like, we should not be expecting that. So anything that you would see that you want to share with us, if you disagree with our outlook that we've come up with here through our routine, comment down in the YouTube section down below. All right, now let's transition to what's driving this action. You can see not a whole lot on the calendar here today. I spent a lot of time in yesterday's portfolio management class on Market Scholars talking about these indicators. Big basket yesterday. Essentially, the economic surprise index is very negative for the U.S., as negative as we've been since 2007, the mid part of 2017, when it really made a big jump, to the downside. You can see the odds of a rate hike, and I don't think this goes back. The history won't go back too far. Yeah, it only goes back to 2018. But here's the odds of a rate hike of no rate hike in 2019, and they're still very, very high. And again, very low odds of one rate hike. So this is no rate hike. This is one rate hike. 3% is all for all of 2019, and we actually have 4 times that is the odds of a rate cut, one rate cut, which is also very low too, but this shows how low the odds of a rate hike are. The GDP estimates have really come down. That's why your economic surprise index, you can see, has dropped. This is now 1.4%. Will be updated again on Monday, and the advanced number will finally be released for the fourth quarter because it's been delayed with the shutdown. It'll finally be released next week, next Thursday on the 28th. But the estimate will be updated on Monday. If you take a look at the calendar here for next week, economic calendar, there's the GDP release that we'll finally get, as well as the Chicago PMI, the last PMI before we get the ISM. Remember, the Philly Fed survey went negative. The Empire State Manufacturing is also pretty low, so it'll be interesting to see what happens to these. This Chicago, the other major regional manufacturing survey before we get the national survey here in the ISM. You can see you have trade data, and you have Powell coming out speaking in the next couple of days next week on the 26th. You see he's going to be speaking before the Senate, his semi-annual monetary report. And then it really gets fun when he goes before the House, because the House, they whatever your political standing is, when the Fed chair goes before the House, the questions get a lot more fun to see. They're not nearly as nuanced and not nearly as experienced, I guess would be a good way to say, as people have been in the Senate for as long as a lot of those people have been in the Senate on that particular committee. So that's going to be coming out, right? And remember, it was him talking off the cuff at the FOMC press conference in December that caused a lot of that bearishness. He's had to backtrack. You have consumer confidence as well. Housing starts. Housing has been so bearish. It's kind of a leading indicator. You can see how it's been rolling over. We'll see if we jump back up to 1,300 or stay, or even drop back down below 1,200 and continue with the downward decline here. So that will be out. And then, of course, the Monday you have the Dallas Fed manufacturing surveys. So that kind of more of an energy-related manufacturing. So we'll see Not as important as Chicago or Philly Fed or even the Empire State, but still one to kind of keep an eye on for Monday. So a pretty packed calendar here next week. A lot of Fed speak, and the end of the week finishes pretty strong too, with personal income and spending, as well as national ISM and consumer sentiment. This would be the revision of the consumer sentiment at the end of the month, which is the first day of the month actually in this case. So a lot of data out that can influence, but remember the economic data has been pretty negative. That's going to continue to pressure yields. When you look at just how things have performed here this week in terms of the major asset classes. Let's just go to here we are this week. We'll go to 10 minutes. Long-term bonds have been down, right? But that's been kind of a temporary thing. Long-term bonds have actually done really. I mean, since October the 3rd, since the time the stock market peaked, excuse me, and the subsequent rally, long-term gold and long-term bonds have been the two best performers. Emerging markets are starting to move up there too, but long-term bonds and gold, long-term bonds are up 4% since the peak and then the subsequent rally in the stock market. And look at gold. Gold was strong during the drop, and it was up 5%. It has doubled that return during the rally. So kind of shows you that the market still is not completely risk on here. That some of these other asset classes like bonds that were up, and they have stayed up, even though the stock market. So when you look at the 10-year note, off of that December 24th low point, when you take a look here, here, let's look at a daily chart for it instead. The 10-year note, TNX, since that, so there's your December 24th low point, and then we rallied, right? The stock market rallied too, but from the 18th, you can see the yields have actually been down, and you can see they're down just a smidgen this week, but yields continue to be down. The TYX, the 30-year, which is more economic growth related, is actually up this week. This is TLT, right? It's actually up this week, but still well off of its January 18th, so that January expiration. Remember how we looked for weakness coming out of January expiration based on seasonality in the stock market? We expected some weakness here in the stock market. You got it in yields. You did not get it in stocks, right? Stocks came out with about a week of weakness, and then we were way up. So again, another one of those kind of frothy signs in the stock market. The bond market's not confirming this at all. When the economic indicators, as bearish as they are, will continue to not. I mean, that will continue to put pressure on these long-term bonds as long as these indicators stay as bearish as they meet. The posture right now for the 30-year yield is getting progressively bearish as this intermediate line rolls over, and we don't have a red moving average yet to go with this dark pink shading, but we are below the moving average, and the moving average has gone from 30.37 to 30, still at 30.37, so it's still going to be flat there. So once it does move lower, the green line here, once it moves down this even 1/100th of a point, it will turn dark red, because we're already below it, depending upon how we finish on Monday. So kind of this shows you how bearish we are in these yields. The 10-year note does have the dark pink shading, bearish posture, as well as the dark red line below a falling moving average. Quick look at the sector moves here for this week, and you see some interesting bedfellows right there at the top. You have materials, which is kind of aligning with that move in gold, as well as utilities, which reflects a weakness in yields, both moving to the upside. But you also have technology and discretionary, bullish cyclical sectors, strongly outpacing the broad market as a whole. Whereas on the other side of the equation, you have healthcare, energy, communication services, not really all linked together anyway, but they're all lagging behind along with staples and real estate, and then this would be financials. So interest rate sensitive, dollar sensitive, cyclicals, safe haven, all kind of lagging. Now you could say, remember, communication services also has that link to these high yielding telecom type stocks. So kind of it seems like with real estate and healthcare and staples kind of matching, the safe haven attributes of the sector is kind of what dominated its performance here this week. Whereas the more cyclical areas, technology and discretionary, have had a really strong run this week. And if I go back over the past 4 weeks, look at the 4-week run. So 1, 2, 3, 1, 2, 3, 1, 2, 3, 4. So that January 28th, and let's go a little bit longer. All right, so over that 4-week, look at industrials, strong, utilities strong, and technology strong. So again, not what you would expect. Those three don't usually go together. Real estate and staples continue to perform very well over the 4 weeks with a strong move higher. Whereas on the other end of the spectrum, look at financial struggling with those lower yields. And you also see other cyclical areas too, discretionary and communication services lagging behind despite the strength that we see in technology. So this is a bullish move. It's been a strong bullish move, and your safe haven areas, and along with industrials, industrial is kind of the outlier, but these other safe haven areas, utility, real estate, and staples, all outperforming. So again, kind of shows this is not the most bullish, and there's a lot of noise right now. Not the most bullish of moves yet that would establish a long bullish trend. Right, you usually see those safe haven areas outperform at the end of bullish moves. So it kind of makes you wonder if this is 4-week cycle is suggesting that this may be the last 4 weeks of this bullish run that we're on right now, anticipating more of that intermediate pullback that we haven't gotten yet. Now, one stock that's on a nice, good bullish trend here that is showing an overbought cluster on its market forecast indicator. But might be one of those overbought clusters that kind of signals the beginning of trends rather than the end of an extended trend, kind of an exhaustion of an existing trend, is Yum Brands. You can see it's been consolidating. In fact, if you look at its volume chart for the year, for the past 52 weeks, you can see we built a strong base of volume in here, right about 99.5. We've kind of broken out up above it. We've gone through earnings. We've bounced back towards that moving average. Held that this would be the 20-day exponential moving average in between the Bollinger Band. Held that, pushed back up. The Bollinger Bandwidth is relatively low, and if you look at the DMI, excuse me, its DMI is not quite above 20 yet. It's trying to make its way up. Right, the trend is strengthening and kind of building strength. You see that as well in this other trend strength indicators here. It's above 5. This would be on a weekly chart, mind you, but it's above 5 and it's above 85. So it's got the beginnings of a strong bullish trend right now on the weekly chart. On the daily chart, you can see we're in the moderate, right? So you're in between. You're above 65 and you're above 2, but not above 5 and 85 yet. So the daily trend is a moderate trend with a weekly trend showing a strong bullish trend on the weekly chart. So it's got a nice little run going here from a 3 green arrow standpoint. You look at Yum Brands. We're obviously above that 8-day moving average. We had come down below it, so that's nice and healthy. Like, we're not seeing that on the S&P, but we did here. We tested the 17-day. We bounced off the 30 on an intraday basis. The MACD and stochastic getting above their moving averages. They're not aggressively high, so we have some opportunity to do some bullish trades on this, at least in the short term, as we continue to maintain. Now, we're still 21 days out. If you look at the options here, like the 94, 92, you're not quite getting enough premium to justify, even though you are 21 days out. So I'm going to go a little bit further out to 55 and look at these options. And you look at the 92.5 and the 90, you're still relatively low. So you actually have to go up to this 95, which is about where we're at right now, and sell that 95 put. So it's really close to being at the money, if not right at the money. In fact, if you take a look at the extrinsic, it is the at the money option. So you'd have to sell that at the money and buy the 92.5, Again, it's relatively widespread. That's why the credits the credit isn't as high. But you'd have to set that stop limit order here at about 60 cents, because that's when you want to get filled in at. Set that stop limit order. It takes a move up to above 96 for us to get filled in, so we'd have to continue this trend higher. But that would allow us to be bullish on this stock. It's got, right now it's got a lower probability of success. Set the break even at 55%. But remember, this is requiring a move on the stock up to 96.17 before we get filled in. At that point, it would have a higher probability of success, assuming that it happens, like let's say it happens in another couple of days. You still have a above 60% chance of success. You have a 30% return on risk, and then you set that break even here on the chart, and you can see basically would be holding these old high. You would expect that you would hold those old highs for support coming off that earnings. We trend higher, right? That's how you maintain. And if you can get most of that move early, great. Take most of the gain, take that half that gain, instead of waiting for that slow pace for the other half. Move on to something else. But you've got a nice little trend here that you can start to build a position, if you haven't already, in Yum Brands, with that overbought cluster showing, not in the overbought cluster not showing that we are kind of exhausting this long bullish trend that we've been on, but more showing how bullish we are now in the short term, and how that can help start and build more of a long extended bullish trend. You don't always get them. A lot of times you'll start to get them towards the end as you've already been bullish. And here we had this little weak bearishness, and this is kind of saying, okay, let's see if we can't start something here with how strong the trends are on those trend quality indicators. All right, well, that does it for this week. Thank you very much for watching. Remember to let's take the conversation to the Market Outlook forums on marketscholars.com. Any questions or comments you have, post those there. You have to subscribe to our site to participate in those forums, but you can do that for free. I showed you how to do earlier in the video. Remember, you can also reply to anybody else's threads with anything that you may see or any perspectives you have. Again, thank you very much for watching. Have a great rest of your weekend, everybody. Subscribe to our YouTube channel. Click that thumbs up icon. Comment on the video. Follow me on Twitter for more content. Join our community on Facebook as well as on marketscholars.com. Have a great weekend. We'll see you all on Monday.